$2 trillion in market value were wiped out in software stocks in the first quarter of 2026, and Wall Street is naturally asking the question which companies will prevail in the AI era and which ones won't survive. We're taking a close look at 3 exciting stocks and will answer the question of which of them might be the secret winners here. Before we begin, a quick disclaimer. Everything I say is not a recommendation to buy or sell, nor is it professional financial advice. It is simply my own personal opinion, right? So let's look at 3 stocks, 3 potentially exciting investment opportunities, or perhaps not. We'll take a look at that in a moment in the chart and fundamental analysis. And of course, we'll also examine the business model, because that's what you need to get a handle on and understand whether these companies' business models can be completely disrupted or if it's possible to adapt them so that they can benefit from the AI era and the agentic era, the era of agents. Yes, there are, of course, 3 criteria that are going to be especially important for us to consider to survive in this age of artificial intelligence. And the very first thing, of course, is ensuring you have a certain kind of moat, that the software isn't just some pure software built on simple licenses, but rather that it's much more of an expansive ecosystem in which various AI agents will operate. This ultimately means that you are essentially building a robust system of record here, rather than just a simple system of engagement. That is the important the key difference that you have to understand regarding the company making this transition, that you have this system of record, a system in which the AI operates, that this a system that the AI uses is offered here and not the other way around. Then, of course, there's the all-important question of monetization. So how can this new business model in the AI era ultimately generate revenue? And it's important to assess that, of course, in the past, it was always the case that you paid for software licenses, but we're moving away from having one-time or recurring licenses for a company. Instead, we're actually moving towards a point where basically the revenue or payment, the software usage, is based on the extent to which it's used, whether by humans or by AI agents. And this is going to be a very, very exciting area to see to what extent companies will be able to pull this off. We'll take a look at that with ServiceNow, Salesforce, and Adobe in just a moment. And of course, the proof is in the pudding, because it's all for nothing if it's just theory and you don't see it in the quarterly results. Let's start right away with the first stock, and that is ServiceNow. ServiceNow is a subject of intense debate, and in and it is an exciting prospect. I am considering adding it to my portfolio. However, we will discuss that after the verdict, once we have taken a look at the broader market picture. The chart illustrates the stock plummeting from its high of $240, a decline of over 60%. And this question here is, we are clearly in a strong downtrend, and the market is essentially pricing in the disruption of the business model. And the question is, where will the stock find support? We had the quarterly results, which were quite interesting and actually not that bad. And if we look at the key figures in the AI sectors, well, there's some very, very interesting information to be gleaned that increases the opportunities for ServiceNow. But based on the current situation, I would actually still say, okay, from a purely technical standpoint, we are still looking for a bottom here. What I generally like is that while we obviously have this strong downtrend, some volatility is starting to creep in, and this volatility, these rapid changes in direction are things you normally see at the end of a downtrend, or conversely at the end of an uptrend. And I'm speculating a bit that ServiceNow stock somewhere in the range between $80 and $90, or let's say a slightly wider range, has a good chance of finding a bottom here, so we can then start an investment accordingly, provided the fundamentals align. After all, you have to understand, okay, what is it that makes ServiceNow capable of surviving this AI revolution? And when we look at the AI moat, it's actually interesting to see that ServiceNow is in the process of building a system of record. So exactly that system that uses AI, that AI is built upon rather than being replaced by AI. ServiceNow acts as a key partner for all workflows across IT, HR, and customer service, effectively integrating everything into one single unified platform. And that is precisely what makes ServiceNow so interesting. It is the ideal environment where advanced AI agents can then be deployed and utilized accordingly. And AI agents need clean, consistent data so that the result is reliable as well. And that's where ServiceNow comes in. And what's particularly interesting is that the business model is increasingly being built on and geared towards this AI. You link the data from all of these various areas and from all of these workflows to achieve a much better result within the AI outputs. Yes, they have also officially announced the repositioning the AI control tower for business reinvention. That's the motto ServiceNow has adopted. And that's not just marketing fluff. It's actually a strategy that's slowly becoming visible in the quarterly results. Because if we look at the quarterly figures, well, you can actually see evidence here that the AI thesis is real and that they are indeed able to profit from AI growth. We are seeing very strong revenue growth, especially with Assist, or rather Now Assist, a very important business division for ServiceNow. There has been 130% growth in new customers, and new business has increased by 50%. So despite the fact that the figures themselves are very good, the stock reacted negatively upon their release. I believe it was last week when the figures were published, for reasons that, in my opinion, are only short-term, with delays in the Now deal. Yes, of course, due to the current situation, they are coming later, but they will come. And I think that ServiceNow is really very well positioned here. AI Control Tower deals have basically tripled quarter over quarter. Those are truly impressive, solid growth figures in the exact sector we're most interested in. I'm being very cautious here. Well, perhaps not cautious. One should always be cautious, of course, but I'm quite optimistic that ServiceNow can pull it off. I'm not investing just yet, but ServiceNow is definitely at the top of my watch list. However, you must still continue to keep those potential threats in the back of your mind at all times. Also, the fact that AI is, of course, replacing employees, and to what extent revenue might shrink as a result, is still a bit of a big question that remains to be answered, because clearly ServiceNow might not be completely disrupted, but the question remains whether that revenue growth can be maintained, or if we might see some cuts there. And there's also the significant competitive threat posed by the major hyperscalers. If they were to decide to enter ServiceNow's specific business model with their own integrated workflows and advanced AI platforms, it could, in a very real sense, potentially weaken ServiceNow's competitive moat. That is always something that you should keep in the back of your mind and continue to keep a very close eye on. So the market remains a bit divided, as can also be seen in the share price, and accordingly ServiceNow is certainly still to be treated with caution. But nonetheless, I believe that AI cannot pose too much of a threat to ServiceNow here, and that currently you have quite an exciting stock in ServiceNow. Let's take a look at the valuation. Because, of course, when a particular stock has fallen quite this far, you might be inclined to think that it's cheap. And if we take a closer look at the price to sales ratio, we actually see that relative to the entire history of ServiceNow, with a price to sales ratio sitting at just under 7, we are historically cheap. In point of fact, we are at an all-time low. Basically, the exact same thing applies to the price-earnings ratio. Sure, you have high growth rates, which is why the nominal figures for the price-earnings ratio and the price-to-sales ratio are correspondingly high. That naturally also means that this revenue growth must be maintained, and if there is any weakness here, then the stock is actually not necessarily cheap at the current level, and that would conversely mean that the bottom has not yet been reached. Nonetheless, Mama Sam, bevor wir so das haben mal Sam afginabam Gina Kinabun pszenichsin bi Maifans Mam was meinem eines dann auf das Saubente to what tables einschätze, and free cash flows are increasing continuously. There is no debt, and a healthy amount of cash has been built up over the last few years. So fundamentally speaking, the company is in a very strong position. The only important question is, will we see a slowdown in revenue growth, or can it actually be accelerated by the AI revolution? those are the key questions. If it is possible to maintain acceleration or even constant growth in revenue and profit here, then in my opinion, the stock is definitely too cheap at the current level. However, as I said, it should still be approached with caution. From a technical standpoint, we are in a downtrend. I'm keeping an eye on which direction it goes. Sure, obviously this isn't investment advice, but if you're considering getting into a stock like this, it might be interesting, or rather a good idea, to buy in tranches, maybe buy a portion now, and if the stock happens to drop further, you can add to your position accordingly. Assuming, of course, that you're convinced ServiceNow can survive in the long run. So let's move on to the next stock, and that's Salesforce. Another stock that has really taken a beating. And if we take a look at the chart here, we can see that at one point there was a price drop of over 50%. And ServiceNow, if we look at the valuation, has reached a very, very attractive level with a price to sales ratio of 4. Historically, we've only really seen that in 2022 and 2009. So you can see the stock has been, really heavily punished. And fundamentally, Salesforce, I actually see the stock as being positioned similarly to SAP. That means there's essentially a moat, and accordingly, I see the risk as moderate when it comes to any real disruption here. In terms of the price to earnings ratio, the stock has also become really very cheap. Yes, we now only have a price to earnings ratio of just over 23. Looking at the history, that's really historically cheap for Salesforce. Gross margins are stable, free cash flows are stable, and the net profit margin is stable as well. So from a fundamental perspective, the stock is certainly interesting. And the question now, of course, is to what extent can Salesforce be disrupted, or does it have a moat? And because you are so deeply entrenched within these companies and their data, you naturally possess a very significant and sustainable competitive moat. And you can also effectively leverage that unique position for preparing and provisioning high quality data for your AI agents. And in the second step, this Agentforce is then monetized by selling a pay-per-agent work unit model, meaning that you basically no longer charge $2 per user per day or something, but rather 10 cents per action. This naturally implies even more room for further scaling, depending on what the actual market demand looks like at any given time. Fundamentally, these AI agents can be scaled up infinitely depending on the specific requirements of the situation. There is definitely significant potential, though it remains a question as to how things will ultimately turn out for us. But we are, of course, in a situation now that is risky, but also offers corresponding opportunities. And if we take a look at the concrete numbers here in the AI space, we see very, very strong growth figures in the Agentforce area, and a very, very strong proof that the theory can work is the hotel chain Wyndham Hotels, which is already using AI Agentforce in its hotels, and where the product is being very, very well received. Naturally, we are also required to address the potential threats quite clearly. Will our revenue growth continue at this current pace, or is it likely to slow down? That is the most critical question, and naturally, it is also something we must consider. And then regarding the competition, to what extent could OpenAI, Anthropic, or Google potentially pose a threat to Salesforce here? Nevertheless, I find Salesforce very, very exciting, and here too the stock has become quite interesting due to the lower valuation. In my opinion, it's definitely worth adding to your watch list for an investment. As I said, not investment advice, but if you had to choose, I would actually switch currently between ServiceNow and Salesforce. Let's take a look at Adobe. Adobe is also a very, very exciting stock that has really taken a beating and has fallen even further from its all-time high, or rather its recent high. If we look at that, the stock has also dropped over 60%, and there is no end in sight. From a purely technical standpoint, we are still in an intact downtrend, and with Adobe, when we look at all the image generation tools from Gemini, Nano Banana, etc., the question naturally arises as to what extent Adobe still has a unique selling point. Of course, you have a loyal customer base supported by a truly solid product, but can you really manage to retain those customers, or is the competition growing? And if that competition continues to grow, that naturally also means significant mounting pressure on your profit margins. while we have seen that the gross margin has been significantly increased in recent years from just over 80 to nearly 90%, when you face competition, it also means you can't maintain your prices, and ultimately your margins will come under pressure. That the net profit margin is stagnating, or rather it's even falling slightly. We haven't seen any growth here for quite some time, and the stock price reflects that. It doesn't look good. The valuation has naturally come down as well. Yeah, we're at a price to sales ratio of 4. Adobe was last at that level in 2012, so it's been a long time since Adobe was this cheap. But the stock market is pricing in the fact that there will be competition, that this growth cannot be sustained, and then the stock price ultimately has to fall. In terms of the price earnings ratio, it is also very cheap, similar to 2011 or 2009, with a price earnings ratio of between 14 and 15 to be exact. And at first glance, that naturally makes the stock look like a good investment. But in reality, I would say that Adobe, because of its economic moat, is the weakest of the 3 stocks. Just as I mentioned before, with the competition it's facing from Google or other AI providers. And the question is, of course, whether they can maintain the customer base here. That's the thing. Adobe obviously needs to deliver accordingly, and in the end, it remains to be seen whether Adobe can maintain this market position or not. If we take a look at the numbers, that might be a bit of a comfort pill for everyone who's afraid that Adobe might disappear. Despite the threats, the numbers aren't actually that bad, and that is actually a glimmer of hope, or rather something to keep an eye on if you're speculating or believe that Adobe can manage to pull off a turnaround here. After all, Firefly subscriptions have seen significant growth, and the other figures for video and audio generation have also grown quite a bit. This suggests that Adobe certainly has the potential to survive in this market and continue to be a top player. At the end of the day, what counts is the quality of video and image generation and editing, and the question isn't to what extent or whether Adobe is good, they've already proven that, but rather how good the competition will become. That is the central question we need to be asking regarding Adobe. When we look at the results, it seems far more uncertain than other stocks, primarily because Adobe lacks a strong defensible competitive moat, and their rivals could quite easily step in and take their customers. That is certainly something we need to keep a very close eye on. Nevertheless, the current valuation is favorable, but it is possible that it could get even more attractive in the future. And in the current environment, that is exactly what you need to watch out for, so you don't get in too early. And accordingly, I don't find Adobe that interesting, and would, if anything, rather invest in the likes of ServiceNow or Salesforce. To name other stocks, for example, Microsoft can also be seen in a similar sector, and they could also benefit significantly here. Just a side note. Well, that's it from my side. I hope you enjoyed the video, and if you did, feel free to leave a thumbs up. See you in the next video. All the best, good luck, and ciao.